we might as well get going. So I wanted to talk a little bit about vehicle expenses today. There are a lot of times different questions about that, and people are unsure because there are options. So what we'll talk about today is there are two methods you can choose when you put a vehicle into service. And we'll go through those briefly. We'll talk about some of the depreciation options, some of the limitations that exist, the documentation rules, and then have a discussion about what's the best method for you and a little Q&A. So that's what we intend to sort of roar through today. And all right, here we go. And as you have questions, feel free to speak out or send something in the chat, and we'll get to those, and then we'll have a Q&A at the end as well. So the two methods I put in a chart, and I see that it got a little graphic in the way of it, but if you look at the different aspects, the two standard methods you can choose are the standard mileage rate, which varies from year to year, and the actual expense method. So I might just go through a little bit of this. The standard mileage rate is based on the number of business miles you drive in a year times a rate that the IRS determines, and it changes year to year, and it's based on the cost. So as you can see, of course, we're at a time of high inflation. It wasn't long ago these rates were 55 cents or whatever. Last year was 65 and a half. This year it's 67. So you can see that that adds up in a hurry when you drive 1,000 miles and you can write quite a bit off. So you compare that with the actual expense method. That's actual gas, that's actual insurance, et cetera, et cetera. And as you look at the expenses included, the mileage rate is meant to include everything, including depreciation. The only thing that you can add on is a pro rata bit of interest that you might have. But take mileage, you're basically just mileage and perhaps the interest. If you're taking the actual expense method, then it's everything. So in terms of record keeping, one thing that many people don't understand is whether you're taking a mileage deduction or actual expense deduction, in the event of an audit, the IRS requires a mileage log. You have to report total miles and then business miles driven. And we'll get into documentation in a little bit. Put together a little thing there on that. But if you have the actual expense method, you also need to then track all of your actual expenses. So there's more accounting to the actual expense method. Depreciation, as we move down this chart, depreciation is a component included in the mileage rate. It's a separate calculation then added to your actual expenses on the actual expense method. And then, of course, the documentation, both of them, you need a mileage log, but then you have to keep receipts to be able to prove your insurance and your maintenance and your oil changes and whatever. So in terms of flexibility, the standard mileage rate is easier. It's simpler in terms of you just plug it in our tax program, multiplies it out, and comes up with a number. The other, you've got to account for all your expenses. Bonus depreciation, not applicable under the standard mileage rate typically, and it's available, well, it's certainly not applicable under the mileage. You don't get to use bonus depreciation. You don't get to use Section 179, expense write-offs for assets, etc. And then you do get those options under the actual expense method, but there are other limitations we'll get to. Now, a long time ago, when I first started practicing, doctors, dad had hung out a shingle in Dallas, and doctors, could go get, at that time, it would be an expensive Porsche. I don't know, $60,000 Porsche was hugely expensive, and write that off, on their taxes. So they brought in these luxury vehicle limitations. You can't get $1 million whatever Lamborghini and depreciate it. So we'll get into some of those limits in a little bit. So there is no limit on mileage. I mean, you can have your Lamborghini and you're going to get to take 67 cents a mile, just like a person driving a Honda Civic. So now, one thing that I want to make very clear is that once you choose a method for a vehicle, when you place it in service for business, you stick with that method throughout. Generally speaking, if you take depreciation as the way the rules read, but everybody does. So Once you start with depreciation and actual expenses, that's what you're stuck with for the life of that vehicle as you use it. Um, if you can't just go back and forth and pick which one's going to be best for you year to year. So I don't know if we have any questions, or if that's kind of a quick overview of the two methods you have for deducting business expenses that you get to choose when you place a vehicle into service. So let's move on and talk a little bit about depreciation limits. Now, these are the limits that are placed. These limit numbers are based on 100% business use. So it gets ratcheted down. If you use your vehicle for 80%, then these rates come down, or the limits come down. So as you can see, the way that they've kind of, if you look at regular vehicles, which are under 6,000 pounds gross vehicle weight, I don't care if it costs, again, if it's $1 million collectible car, the maximum depreciation in that first year is $12,400. Furthermore, you do not get the Section 179. You can take some of now it's a 60% bonus. I might mention that, we're well aware that the House passed a tax package that reinstores the 100% bonus depreciation. But we don't know what the Senate's going to do. So I don't talk about those things much until they actually happen. So I'm basing this on current law. So in 24, the bonus depreciation is limited to 60%. But total depreciation then for a vehicle is limited to $20,400 in that first year. Then trucks and vans and SUVs that are over 6,000 pounds gross vehicle weight, that's a magic number, and over 50% business use, you can take depreciation. You can take up to $30,000 in Section 179. And you can take that 60% bonus. So if you buy an $80,000 Raptor, which we've had clients do that travel to work an oil patch or whatever, then you're going to get a large bonus depreciation on that. So those are the big difference. There are two big differences here to keep in mind when you're taking depreciation. And I'll say again, I think for most people, mileage works out over the life of a vehicle better than actual expenses and depreciation. There's some rare cases where people are just really wanting to write that big chunk off in the first year of purchase, but most of the time mileage. But there are limitations on the depreciation you could take, and the numbers that determine how much you can take are, you have to have an over 50% business use to be able to get some of the accelerated depreciation, assuming that's a vehicle over 6,000 pounds gross vehicle weight. So those are the big numbers. And those are for trucks, vans, heavy SUVs, that counts. Now here are some limitations. Again, I put in this graphic, the magic 6,000 pounds number. Commuting miles never count. If you go straight from home to a client's and you normally have a 10-mile drive to the office and the client's 50 miles away, you get to count 40 miles of that first trip of the day. So commuting miles are never considered business. And now if you office from your home, then pretty much, now your day starts. You can't use the mileage method if you have more than 5 or more vehicles. So you have to go with actual. And that doesn't happen, very often, but it can, especially some people that have larger construction companies. Again, you have to have over 50% business use to take the Section 179 or bonus depreciation. And by the way, a lot of people don't know this, but if you start out over 50% business use and later it falls below 50% business use, you're supposed to go back and recapture. It's a real pain in the rear. We've had it happen a few times. You go back and recapture that accelerated depreciation you took early in the life of the vehicle. So, these things go into planning of what you're going to do in the future. If you use a vehicle for under 50% business use, you don't get the accelerated depreciation. You have to use straight line. So those are some of the limitations. I mean, the rules are pretty complicated in the IRS stuff. I'm breaking down the simple. So any questions or comments so far? I'm looking to see if I have any chat stuff here. Chat. You can chat with me. Nope, nobody's chatting. You can send me a question or speak up, please. I love interactive stuff. I hate sort of speaking to myself, but anyway, such is the limitation of not being in a room with you. So which should you choose? And we can make this even a little discussion if you have some other things you can think of. Well, your current tax situation. Look, many people may say, "Look, I want to expense off my costly vehicle because I want to kick the can down the road. I know I may owe some more taxes next year or the year after, but I'm worried about this year." That's very common, and so you have to take that in consideration. I'm going to buy a new truck, I'm going to write it all off. But of course, you write it all off that first year. I call it robbing Peter to pay Paul. You don't have that deduction over if you're going to use that truck or heavy SUV or van 5 years in your business. So you may get a great benefit this year and may hurt you in future years. So you have to take into account as well your future tax considerations. The other thing is when you sell or trade your vehicle, if you've taken that all off, you're more than likely going to have a gain and you will pay tax at ordinary income tax rates on that depreciation that you've taken in the past. So those are some things to consider. There's a couple of other things that I didn't really put in here, but I'll speak to a little bit. Questions I get a lot of times are about, look, I think I just had this yesterday. I got a new truck for my small business and I have an LLC. Should I title my truck in the name of my LLC? And the answer to that is really, in some respects, it depends. The LLC exists to limit your liability if something bad happens. And where that can really be important is if you've got other people driving your trucks or using your equipment, yes, you would want to have those titled inside your LLC. The best protection you're going to have is probably good general liability insurance too. But if it's your truck and you're taking mileage, in some ways it really doesn't matter. Because you can put that in your LLC all you want. If you're negligent and hurt somebody, your LLC is going to get pierced and you're going to get sued personally anyway. So many times, if the truck is titled personally, used inside the business, we still claim that mileage and it's not a problem. It can be a little tricky sometimes to do the borrowing if you finance inside an LLC. So that's a question I get a lot of times. Do I have to put that truck inside my LLC to get the write-off? No, if it's just a closely held business and it's you, no, you don't. But anyway, we usually recommend to most people to simplify the accounting for all the gas receipts and everything else, and to spread the deduction over the useful life of the vehicle. Take mileage, especially since the rates are so high right now. It ends up being a really nice deduction. You drive 10,000 business miles in a year and you're getting a $6,700 deduction, and maybe that saves you 30% in tax. That saves you a couple $1,000 at least, depending on your situation. So that's my little 2 cents about, I would say probably 90% of the clients we have use mileage. Now, documentation. Let me talk about this a little bit. What I am doing is giving you what the IRS has in their publication. It's so funny. I think it's ironic. They have a disclaimer. This is not an official Internal Revenue form, but it's found in IRS publication 463. So there you go. If you ever get audited, they would love to see date, destination, business purpose, start and stop odometer readings, the miles on this trip, and certainly that's for mileage. And then these other expenses normally are accounted for elsewhere. We've seen Oh, I can remember one audit where the fellow did not, this has been years ago, had not kept a mileage log contemporaneously, and the agent let him reconstruct one based on his business calendar. And so he could go, yeah, I see you made a trip to Longview for this client and you went here. So he was able to go back and kind of come up with a log. Other people keep kind of weekly logs. You know, I saw clients in Tyler and I made 2 trips to Longview for supplies and this and that. So there's a weekly total. So it just kind of depends. I've listed some apps that are available that people can use, and you can find your own. Some people like doing this. So they'll just get an app that's set and trip log mileage, Hurdle, Everlance, Mile IQ. Obviously, you can't click through on these, but hopefully on the website we'll post these links if you want to try some of those. But for most business expenses, was what the IRS, if you have not entertainment, but meals, you would add to this the relationship, the name of the person and the relationship. Those are not applicable here, but the IRS would love to see this detail. Having said that, you just document your business miles. You got to report total miles and business miles. If you get audited, you're going to have to substantiate what those business miles were for. Why were they business? And again, I think as a practical point, the start and stop odometer reading, some people aren't going to go to that level, but they know that it's, from my home office to Tyler is 27 miles there. And I'm driving around town 10 miles during the day to see a couple clients. And then I come home, I did, whatever that is, 64 miles today to see these clients and pick up supplies. And that would be very adequate in an audit, I believe. Probably more than most people would provide. So I don't know if anybody has any questions on the documentation. This is an unofficial IRS form. So that's kind of it. I like to make these short and sweet. Does anybody have any questions? And as I say here, no, wrapping your vehicle in an ad does not make all mileage business. Some people think so. You get to deduct the cost of the wrap as advertising, but business mileage is still a business trip. That's seeing somebody, that's picking up supplies related to business. That's whatever you're doing. You're traveling for business, or you're doing something for business. That's business mileage. Anybody have any questions?
Hi, Steve. I got a question.
Yeah.
Do you notice a lot of audits for mileage deductions?
No, as a matter of fact, less than 2%. You'd have to win the lotto to get audited. Now, of course, the idea was to bring in, 80,000 more agents and really ratchet up the audits. But I've seen, it's been many years, some of the things that trigger audit are exceptionally high travel expenses. And that triggered one once. And so mileage was a part of that. And this person did travel a lot, but substantiating all of it was kind of tough. And there ended up being an adjustment, if I recall correctly. But no, I don't think, if it's reasonable, if it's reasonable, mileage in itself probably isn't going to trigger an audit. The way the IRS works is some of these things are computerized where, they look at these things and is this outside of a deal? And then is it enough? Is it worth us messing with, since they're so short staffed and behind on everything? So I'm not saying it will, or I'm not saying it won't. I don't know if that's a helpful answer, but I don't. The old thing with the IRS again is that pigs get fat and hogs get slaughtered. And what I mean by that is I think it's okay to be moderately aggressive on trying to document that you have a business purpose for a trip and this and that. If you're taking like 99%, consistently taking 99, I'm driving 20,000 miles a year and it's my only vehicle and I'm doing 99% business, that doesn't pass the smell test. So that's being hoggish. And that could trigger something that, come on. You got to go to the grocery store for yourself and run your kids to school and whatever. Go to the sports bar to watch the Super Bowl. So it could, if it was unreasonable. And I understand people estimate. I do understand people estimate mileage. I think I drove 15,000 and it was probably 80% business. And so, from our perspective here, it's not our job to audit you, but it is our job for it to be reasonable. And it is our job for you to give us something in writing that's what you're declaring. And then according to the terms of our engagement letter, we put that in the return, but that's your responsibility and not ours, is the way we look at it. But I hope this is kind of clarifying some of what happens. I think some of the biggest misconceptions are that I can kind of pick and choose my methods from year to year, not quite understanding the limitations, especially on regular size cars. It's important to know about that 6,000 pounds. And all dealers are going to have that out there. They're going to, hey, this truck qualifies. But you should double check that when you buy a vehicle and make sure if you're trying to get a large write-off or larger write-off. And by the way, trading a vehicle in is the same thing as selling it. So the trade-in value is the sales price, and that gets reported as a sale on your tax return. And the difference between that trade-in value and what it's depreciated down to is going to be gain or loss that's taxable on your tax return. So that's important to keep in mind. If you churn these every year, if you churn a new truck every year or something. Any other questions?
I have one more if nobody else had one.
Great, thank you. I appreciate questions.
So the mileage deduction for myself personally makes sense. I've been taking it annually for as long as I can remember. And however, having an LLC that has a lot of operations with not necessarily buying vehicles, but buying tractors, trailers, we have a lot of maintenance. We buy tires, we're buying, doing everything to service it and upgrade it. So what we have been doing, I want to make sure this has been proper, is taking actual expenses for those items under the LLC and not taking any mileage. But personally, on the sales component of my business, I was taking mileage personally.
Well, okay, so you're actually, that's a great question. And we did have this come up in an audit once many years ago, that a person was not really thinking about it, not trying to, and they actually ended up being fine. We get it. They were receiving a mileage reimbursement like in a paycheck and weren't even thinking about that, and then took some deductions personally too for gas and other things. And so you can't double dip. So my answer to that is, if you've got tractors, you really need to, in your accounting records, separate out repairs for equipment, tractors, trailers, other things, and your vehicles. Because when we have tax returns where people pay as they should, they pay for a lot of their vehicle expenses in their LLC, gasoline, it needs to be put to that, accounted for either as a category or subcategories under automobile expense or truck expense versus equipment repairs, truck repairs, because that way we won't double dip. So no, if we're taking mileage for that vehicle, we wouldn't want to also deduct the transmission repair for the same vehicle. Because again, mileage covers everything in the IRS's eyes. Insurance, standard maintenance, big repairs, engine falls out, you got to replace it. I didn't cover it here, but there are very different rules for over the road truck and tractor, units, and that's not many people have those. Some do. Those are depreciated over 3 years. Very different rules if you're driving a big old truck over the road. But we're talking generally just big pickups, big vans, big SUVs. The people are depreciating. But no, you cannot double dip, Joseph.
No, I appreciate the info. I don't necessarily think that I'm double dipping because I'm not reimbursing myself for mileage, but I'll give you a scenario. So let's say we're going to buy tires for the tractor trailer. The LLC would be buying those.
Yeah.
And then that's it. Now,
that's correct.
Personally, on my personal tax return, I'm saying, hey, I drove 12,000 miles last year.
Yeah.
And so that's where
where
I always thought, like, personally, I don't deduct. I should say I'm not keeping a log of all of the oil changes and tires and all that, because I'm just taking the mileage deduction on my person.
You're doing right then. Yes, that's correct.
And then I noted, I understand very clearly the 6,000 pound deduction or minimum for the 179. Now I'm not going to go buy a car this year just for the purposes of the deduction, but I am in the market for a vehicle that's not going to meet the threshold of 6,000, and I would be buying something used this year. So probably a $40,000 purchase price. If I understood you correctly, when you were saying that I would be deducting that over a certain amount of years, the maximum that I could deduct in year one was that the 12,000 or the 20,000 that would be deducted?
It's the 20. So, that would be depreciation. That would be based on 100% business use. If it was 80%. So, I mean, what was it? 2,400, I think. It's 80% business use. The maximum is 16,003 or something like that. But again, then you're selecting to have, that you're saying, if I understand, this is a vehicle that's under 6,000 pounds of gross vehicle weight. And then if you selected to use actual expenses, yes, your depreciation would be limited to that in year one.
And if I selected to use actual expenses for the vehicle, then that would keep me from using mileage deduction?
Correct. You would still have to track and report your mileage, but you would then be taking, if you're going to take depreciation, that means depreciation equals actual expenses as a choice. To take depreciation, they're bundled in with the actual expense model versus the mileage model. So, and again, they're prorated. So if your actual expenses for the year were $5,000 and it's an 80% business use, that means you can deduct $4,000 plus depreciation. So it's a percentage. It's a prorated percentage based on business use versus total. So if you drive a vehicle 15,000 miles, again, and 12,000 of that is mileage, that's 80% business is my point. So you get to take 80% of those expenses you've had during the year. Did I make that clear?
I believe so. And if so, it would mean it's two different deductions. The depreciation is one deduction, and then the percentage of business use, which in your example, it was 80%. So if I had the vehicle that I just bought, 80% of that would be deducted. So I get that part. But if I'm choosing to go now the actual expenses on the mileage part, if I'm back to that 12,000 miles at $1,000 a month, now I'm only going to be getting 80% of that mileage deduction?
Well, okay, so if you're going to depreciate, so if you're going to take depreciation deduction, that means you're going to get 80% of the allowable. I mean, the limits come down 80%, and whatever you buy. I mean, if you bought a $40,000 car, I don't have the program in front of me, but I don't think you're going to run into the limits on a $40,000 car. But anyway, Then you get to take 80% of your actual expenses, but not mileage. So you're not doing the mileage calculation, which is, 1,000, 12,000 business miles times 67 cents, which is whatever, $8,040. That's irrelevant. All that counts is your actual gas receipts, your insurance, your maintenance, your repairs, your tags. And you can still take tolls and parking and all that stuff. But so yeah, if you're going to depreciate a vehicle, you are limited to counting actual expenses during the year for gas and oil and repairs, insurance, registration. Mileage then includes all that. One package is actual plus depreciation, the other package is mileage, includes all that. So it's either or. And I think I could probably head back to that. Let me head back to this, see if it'll let me head back to this slide and put it up. Again, the standard mileage rate includes all expenses and it includes depreciation. So we're looking in this column right here. The actual expense method, gas, oil, repairs, insurance, depreciation, licenses, registration, whatever. And so that's where you take 80% of your actual expenses plus the depreciation, 80% of the depreciation calculation, add those two together. That's your total write-off under the actual expense method. Under the mileage method, you take total miles driven times 67 cents this year. So are you understanding what I'm saying about the two different methods?
Yes, my concern would be that if I've been doing mileage method for a very long time, but now I'm buying this vehicle, at that point, because of the vehicle purchase, I see where I could justify switching over.
Sure.
And now I would have to do the math, right? If it doesn't make sense to switch over or it's the same, then I keep the mileage method. But if I do switch over, I'd have to stay with actual expenses for probably a certain period of time because I'm taking depreciation on that vehicle, not just in year one, but over a couple of years.
Exactly. Yeah. So it does, by the way, choosing a method is per vehicle. So that doesn't mean if you've got some other vehicles in service and they've been on the mileage method, they stay in the mileage method. So the choice is when you acquire a vehicle and you put it in service in your business, that's when you kind of choose what method you're going to use for that first tax filing, and you stick with that as long as you have that vehicle. So you would calculate depreciation every year based on the tables. The computer does that. So anyway, but you're right. You kind of have to do the math.
That helps out a lot.
Yeah, you do the math, and like I said, when you're making a choice and you think forward about and a lot of people, some people just. And it's a fine decision. I mean, it's a fine decision. There's no right or wrong decision. It's just a choice. Sometimes people are like, I just want to minimize my taxes this year, worry about next year, take the biggest write-off you can. Boom, we'll do it. That's always a client's decision. We give advice and say, well, it may be, you may pay more next year and the year after that you would have, but let's do it.
No, that helps, Steve. That helps a lot. I was thinking it was a catch-all on everything.
Oh, no. No.
Now it makes sense. I could buy a new vehicle and this one could be depreciated, but the other one that I bought that I've been using mileage on can continue.
Correct.
That makes sense.
Yeah, absolutely.
Yeah, thank you for clarifying that.
John, thanks for asking. Anybody else? Well, what a scintillating topic. How exciting has this been? But it is important. I mean, with what we always say is that, look, the rules regarding business versus personal mileage are that if you're on a business trip to Tyler to see a couple clients and you make an incidental stop or two to grab some groceries, you can, and then you go see a couple other clients. they don't make you worry about that. Now, if you make primarily a trip to Vegas to go, gamble for a week, and then you happen to make a side trip to look at Hoover Dam to see if you want to put one in your backyard, that's a personal trip. But so you've got to kind of, because of especially if you're paying self-employment tax, you want to be aggressive in your business trips and planning those out so you can maximize your mileage deductions. Because especially when people are in service businesses and they don't have a lot of equipment, it's one of the larger write-offs you have on your tax return typically. So that's why it's sort of important to, I think, have clarity.